Доброго ранку. To fully justify the word international in the name of the forum, I will be speaking English. Hope that's okay with you. I think also that it is nicely symbolic that as EBRD, International Financial Institution, we are speaking after the regulators, because the market development is highly dependent on how the regulators work on the development of the market, not only on the protection of investors, consumers, and so on. And I also think that what is even more important after everything is what comes after the regulators and the IFIs have done their job, which is the real market. And I was glad to see or hear the first question being targeted on the real economy, and also the regulators, Timur in particular, referring to the relevance of financial markets to the real economy and the references to exports and agri and other commodities. At risk that Timur will leave this room before I finish, I would also like to say that he's doing a massively great job in terms of the scope of it with rather limited resources. So I think we need to all show appreciation of what he's trying to do. Let me first, how does this work here? Let me first try to map the funding markets as a whole, illustrated by the picture of the largest financial center in Europe still today. So bank loans and the markets where we operate as EBRD, which is today 38 countries, are very much dominated, including Ukraine, by the banking sector in terms of the provision of funding. However, what banks do is obviously giving loans, i.e. debt market. Private equity is important. There is some of it in Ukraine, not too much. Capital markets for both equity and debt, but also for the hedging instruments. Fintech, growing increasingly. Last year alone, the cryptocurrencies themselves financed more than 5 billion in actual projects in real economy, and there is a lot more than crypto to the fintech. And finally, when nobody else wants to take your risk, then there is the triple F sector. I hope you all know what that means. No? It's the family, friends, and fools. So if nobody gives you money, that's your only source to go to. That's not necessarily the best of the sources. It is a proven fact that developed capital market is good for two things. First, it facilitates economic growth. When there are more sources of funding available, companies have a choice. They go for the most efficient of those choices. And that triggers economic growth. What is also a proven fact, specifically also throughout the latest financial crisis, is that developed capital market makes economies more resilient to crisis. I.e., if there is a major dip, then these economies that have capital markets recover much faster, and in some cases, in fact, don't suffer quite as big of a dip. We see that in the US, which is the most developed capital market in the world. We see that in Asia, not only the Asian tigers, so to say, like Korea and others, but also the emerging market countries. We see that close to Ukraine in Poland, which was the only country in Europe that came through the financial crisis without a single year with negative economic growth. And this puzzle illustrates all the individual positive things that it triggers, including innovation, both at the macro level as well as on the micro level. So what do the capital markets do? Baron Rothschild, who is a famous investment banker globally, has once said that the sole purpose of capital markets is to move the money from where it sits to where it is working. And that's exactly what it does. It helps you to mobilize capital, primary market, first of all. It helps to price capital. And again, Timur's comments on the price discovery and the importance of it to the overall efficiency of the economy is crucial. That's mostly the secondary market, but it obviously has effect also on the primary market pricing. And finally, it enables to mitigate the risks. And this is the derivatives market here largely that we have been talking about, which provides a lot of different instruments, but most importantly, the very basic, the so-called plain vanilla derivatives, i.e. interest rate swaps, FX swaps, and so on and so forth. I would like to make one thing clear here, since we are at the Bankers Forum, is that the capital market should by no means be seen as a competitor to the banking market. In fact, I had the opportunity last year in October to be in the US and meet Jamie Dimon, the head of long-term serving head of the JP Morgan, who says, look, the banking sector in the US today, that was 17, is in a much better shape than the banking sector in Europe for a number of reasons. But one of the reasons is that we get a lot of revenues without taking much risk. So in relative terms, the capital market as a provider of finance in the US is significantly larger than in Europe. 75% roughly is financed through the capital markets, whilst only 25% is financed through the bank loans. But who is that takes these companies to the capital market? It's obviously the banks. So there is a lot of fee income coming. And then finally, when we talk about raising funding, then it's not only raising funding for the enterprises, but also for the banks. If you look at what is called the corporate bond market globally, then 80% of that is in fact bank issuance. So of all corporate bonds issued by volume, banks count for roughly 80% and corporates directly only for 20%. So it also provides long-term funding to the banks, which then will be often on lent to the enterprises. This picture is supposed to illustrate that the capital markets can service both small and big. The fintech solutions that are coming out, crowdfunding for instance, and that is something that the EBRD has now started to support in numerous markets. We have just set up a joint venture with Zagreb Stock Exchange, for instance, and Fundabeam, which is the blockchain-based technology startup exchange in Estonia, which has already succeeded to complete 4 successful fundraisings in the first 2 months of operations. And then moving on from this startup scene towards the venture capital growing companies all the way to the large markets, the multiplier effect that one gets in the capital markets is crucially relevant. And then finally, liquidity always creates more liquidity. Where there is an attractive market that is liquid, that enables to both invest and divest, there will be more investors looking at it. This is to illustrate that capital market development is a complex process. It requires, first of all, to set the relevant laws and regulations. And that's what, in Ukraine, the National Bank and the National Securities Market Commission are doing. Part of that is building proper capital market infrastructure. Stock exchanges, trading platforms, settlement, clearing, all the way to the depositories, which would have to be efficient. And that is one of the issues that in Ukraine you have it very fragmented and nobody has the relevant scale to actually become efficient in the process. Once that has happened, the regulatory part, then it all depends on the step-by-step build-up of both supply and demand. Supply being the instruments coming to the market, the issuers issuing, be it bond or equity, and then the demand, i.e. the investment pools. The bigger the investment pools and the longer the list of investable securities, the more developed of a capital market and the more liquid capital market you are going to have. Where is the EBRD standing on all this? The LC2 stands for the local capital and local currency. That's the initiative that I'm leading now globally at the EBRD. The way we see the input of EBRD is essentially through, first of all, pushing for the relevant reforms and doing the policy dialogue, helping to learn also from the experience of other countries. Secondly, providing the technical assistance, mobilizing donor money to get the correct consultants involved. Sometimes we do it also with our own resources. Building knowledge and building capacity of both the market participants, capital market infrastructure, but also the regulators. And then finally, we come in as an investor or as an issuer. So we put our money where our mouth is. We try to follow up the long talks and difficult legal processes by actually becoming a player in the market. And we are doing increasingly more. For instance, for the third year running, we breached in 2017 the number of capital market investments that we make into bonds, IPOs, into pension fund management companies, into stock exchanges. We are today, as EBRD, a shareholder directly in 4 stock exchanges: Moscow, Bucharest, Istanbul, and Zagreb. There is potentially more to come. We're also looking at the post-trade side, the central counterparty, the CCP universe, and we are an issuer. It's interesting to see that whilst the global interest rates have been very low, there is an increasing number of investors, including in London, that are willing to take the currency risk to gain slightly higher yield on their investments. So every single week, the EBRD is issuing numerous what I would call synthetic bonds, which settle in dollars because often the settlement in the local currency is not possible, but that in fact are indexed to be it the Mongolian tugruk or Azeri manat or Armenian dram or whatever it might be, including Ukrainian hryvnia. We use that opportunity to also hedge our own risk so that we can do local currency lending before we can potentially issue in some of these markets directly on the name of the EBRD onshore. A few case studies here. I mean, Poland is the obvious one to pick, even though everybody can always say that, look, it's very difficult to compare Ukraine, which is roughly of the same population, with Poland that is in the EU. But you can see how the numbers for both capital market, market capitalization, but also in terms of the number of trading differ here. I myself, I'm a member of the supervisory board of the Athens Stock Exchange in Greece, for instance, a country that has only a quarter of the population of Ukraine, but where daily trades are somewhere between 70 million euros to 80 million euros on average. And in Ukraine, these trading numbers are about 1,000 times smaller on a daily basis. So what is that made Poland, for instance, a leader in the Central Europe in terms of capital market development? The key trigger here was creating demand. This is my earlier slide with the stones, whereby Poland went through the pension reform and started the second pillar pension system, which then gradually started to accumulate funds in local currency in Polish zloty, which were largely invested, certainly in the early years, to the Polish market. So there is demand, seeking for investment, and surprise, surprise, companies suddenly find that, look, it's good to have an alternative to bank lending. It's good to have a slightly different investor base that takes a longer term view and gives you money not for 3 years or 4 years, but for 5 and 7 years, sometimes 10 years. And then also building, in case of Poland, the non-bank financial sector. So the insurance companies, mutual funds, asset managers are also very important players in that. Over time, Poland became a leader in the Central and Southeastern Europe, including, as you know, listing a lot of Ukrainian companies on the Warsaw Stock Exchange, for instance. Poland is one of only 2 countries in Central Europe that has the EMIR-compliant CCP, or the Central Counterparty System. The only other one is Hungary. The fact that Poland did not suffer from the financial crisis all the way to the economic decline, I already mentioned. Covered bond is something that is an instrument that the banks issue. A market that has existed for 130 years is a total of $2.5 trillion worth globally, and never ever has a single covered bond defaulted anywhere in the world. The trick is that the issuers are banks, and they back the covered bond that they issue with their mortgage loans. And there is always a little bit of over-collateralization in there. So effectively what the investors are buying is a dual recourse instrument. First of all, the repayment comes from the bank. If anything were to happen to the bank that is issuing, they would go to the mortgage pool. And as I said, up to this moment, nobody has ever lost money on the covered bonds. Not all news are good news. You see the bottom one highlighted red, which is that Poland has, a few years ago, scaled back their pension funds, mostly through fiscal issues, whereby they nationalized, if I may say, a significant portion of the pension assets writing off government debt and taking over the pension obligation from the funds. Case study 2 would focus on Armenia and Georgia, countries that are possibly better comparable to Ukraine, where the GDP per capita is roughly the same. These are the 2 prime countries in terms of the reforms over the past 5 years. They have really done a massively good job, mostly being led by central banks / regulators. We have the MOUs in place between EBRD and each of these governments, as well as capital market regulators, with specific action plan, starting all the way from money and repo market, derivatives law, which also Timur mentioned earlier, in Armenia was passed in only 8 months since we decided to do it. I think it's a world record. I don't know of any country that has quite matched that. Improving capital market infrastructure. I mean, in Armenia, you have Nasdaq, OMX as operator. Pension reform is an important aspect. In Armenia, they started collecting pensions to the second pillar on a mandatory basis 2 years ago, and that money is now gradually being invested in the capital market. EBRD has issued local currency bonds in both currencies, Armenian dram and Georgian lari, onshore, offshore. We have done even a Eurobond format, Georgian lari, to the foreign investors successfully last year. And we obviously use these funds to push these local currency funding back to the economy. And Armenia and Georgia have both been in the top 5 in terms of number of local currency loans for EBRD in each of the past 3 years. And finally, in Armenia, for instance, the Federation of Euro and Stock Exchanges moved its head office from Istanbul to Armenia, Yerevan, last year, which is good, nice sign of international recognition that comes with it. Ukrainian capital market, you see that slide is slightly shorter than the other ones, for a good reason, because I think we are still at the infancy, and whilst the potential is there, at the moment the volumes are small. There are too many stock exchanges that fragments the trading. However, we signed an MOU with regulators as well as government 3 years ago now. Several technical advisory projects have been put in place. A lot of these are with the National Securities Market Commission, some also with others. There is a list at the end which I encourage the organizers to share these slides. A consolidation of the 2 depositories is where we started, because we think this is less politically loaded, and then see whether we can, after consolidating the post-trade space, can move to the trading space as well. Derivatives law, which I think is crucial and hopefully will get approved this year. And when the investment opportunities loom for us, then rest assured we will take a look at these very, very carefully to also put our money where our mouth is, as I said. This is the list of the technical advisory projects, too small to read. And then finally, always remember that the competition is global, and if you don't get the money, somebody else will. Thank you very much.